Hi, everybody. I think we'll begin. Thank you for joining our webinar today. We're going to talk about Marquee Funding Group and our platform, specifically how real estate lending and private credit can fit into a balanced portfolio. So Marquee Funding Group's platform specializes in sourcing and originating loan opportunities with conservative equity requirements, crafting investment opportunities that are both secure and offer superior returns. Our focus is on seizing deals that arise from prevailing credit market conditions where qualified borrowers are unable to secure loans through traditional channels. But through our strategic approach, we aim to provide investors with safe investments that deliver consistent returns, driving financial success in dynamic market environments.
Just to touch on that, we are doing real estate secured lending. Every loan that we write is secured by real property. So you are the lender.
Max, why don't you go ahead and introduce yourself?
So yeah, as you can see on the screen, I'm Max Stone, Vice President and Director of Sales here at Marquee. I started my career here in 2012, strictly as a loan officer. My goal at that point in time was just to make contact with as many mortgage brokers and real estate professionals as I possibly could to bring in deals, to bring in loan opportunities for the company. Over time, that role grew. I started establishing relationships with private investor clients who we would then sell those loan transactions to. And since then, through my experience, I've become the sales manager in the office. I underwrite all of the loans that pass through the doors, make sure that all the I's are dotted and T's are crossed before they go into our investment committee for eventual sale or placement into this REIT, which we're talking about today.
And Danielle, can you jump in and introduce yourself?
You're just on mute, Danielle, if you can unmute.
Sorry about that, everyone. My name's Danielle Fine. I'm an executive coordinator here at Marquee Funding Group. I've been working here since 2020, straight out of college in our closing and servicing departments. And when it comes to the Marquee Capital Fund, I work directly with our fund management team, as well as with investors during the onboarding process and customer service throughout the entire process.
And I'm RJ Solovey, the president of Marquee Funding Group. I joined this firm back in 2009 after graduating from the University of Colorado and have been lucky to be mentored by our CEO, Scott Fine, ever since. This company formed in 2009, and we're really excited to walk you through this platform. So where do we fit in a balanced portfolio? I think as an investor who has access to our platform, you're going to be able to get not just consistent good fixed income, but you're going to get real estate exposure, specifically making loans against high quality real estate assets. You're going to have a passive way to get cash flow through our platform, paid out through quarterly dividends, in addition to some tax advantage strategies, which we'll talk about later in the slides. Another great component to our platform and our fund is the diversification you get. Not only are you getting real estate exposure, but you're also getting a non-correlated investment, meaning that your investment with us is not going to move with greater market fluctuations like that of bond markets or stock markets. And so we kind of fit in that fixed income or safety bucket.
Or as I like to call it, poolside income.
Poolside income. So why get involved in real estate credit or an income fund? We talked about cash flow, but having regular periodic payments that we pay out quarterly is a really nice component of an income fund. Increased transparency. We've invested in a great platform where investors can log in and see exactly where our loans are, down to a granular level. You'll be able to see each asset that the fund holds a loan against, the terms of the loan, and it's through that platform you're going to have a lot of transparency, which is a fundamental component of Marquee Funding Group. Downside protection. We have very conservative equity requirements, and that's not only to protect against a default, but also against market volatility. Capital structure seniority is also a component of downside protection. Max can kind of touch on, the benefits of having, a low loan to value asset, but we're in the best part of a capital structure when it comes to real estate. The lender is the first to get paid, and in the event of a default or in a market fluctuation, it's the safest seat in a real estate deal. And we're secured by very high quality real estate collateral that you would want to own in the event of a default. We're talking about locations like Beverly Hills, San Francisco, Calabasas, all the way down to San Diego. These are all really good markets that we believe will hold well in a downturn, but are also highly desirable.
Yeah, you're all going to see some case studies later that show a couple examples of the loans that we've done. I'm going to walk you through loan to value and what that all means, but I just want to hammer this home. If you're familiar with a traditional mortgage product, that's very similar to what we are. You are the bank. By investing in this REIT, you are actually the bank on a variety of properties. So if the borrowers in that product don't pay, we have the ability to foreclose. Later on, you'll see where we're at in terms of loan to value and what that means. Very low loan to value, and that means a lot of equity protection. So in the event that our underwriting didn't end up being perfect and the borrowers don't pay for some reason or something happens to them, you are in a very secure loan transaction as the lender with secured collateral real estate that you have the ability to foreclose on to recoup your investment. So that's the type of product that we're talking about here.
And so having, diversification, which we always preach, being non-correlated to the stock market or bond market, and also having exposure to real estate in a very passive way. There's also investor and fund manager alignment. The fund managers, myself included, are invested shoulder to shoulder with our investors, and we don't participate in profits until the preferred return. In this case, Marquee Capital Fund One's preferred returns 8% is received by our investors. Another thing that people like is the passive nature. When people think of real estate or investors think of real estate, when you own a property, it can be a operationally intensive task. You have to deal with tenants, you have to deal with rent, repairs, maintenance, and it's those oh, that's funny. My daughter just walkie-talkied me. Apologize, guys. Hold on. And so it's that passive nature that investors really like our fund for. And it's very efficient. Our fund is able to operate at a much smaller cost basis than large institutions or banks. So we can really focus on quality transactions and not just chase yield. And then there's some tax advantage strategies. Our fund, being a real estate investment trust, qualifies for what's called a QBI deduction, or qualified business income tax deduction. The dividends you receive from the fund, 20% of those dividends are tax-free.
Just to mention and touch on one thing RJ was saying before, if you're investing in real estate without any of the hassle of management, you don't need to worry about repairs or maintenance on a property. When we service the loans, we make sure that all of the property taxes are paid, all the insurance is paid every time we receive a borrower check. If a borrower check doesn't come in for some reason, we're checking those things anyways to make sure that they're current. And then, of course, maintenance to a property is important, checking on collateral, staying in touch with borrowers. We do all of that, but you're investing in real estate without any management headaches.
And so we're really excited about the next few years in front of us. The way that the Fed has tinkered with rates, it's really tightened up the credit markets. And so we're very bullish in the current credit market because it's widened gaps that were already widened after Dodd-Frank was implemented in 2008, which presents an opportunity for us to capitalize on highly secured mortgage-backed securities and achieve superior fixed income and yields. Our firm, Marquee, has established unbelievable business-to-business relationships, repeat customers that we've cultivated through a grassroots methodology. As Max mentioned earlier in the presentation, we both started making cold calls, and we have relationships kind of throughout the professional spectrum, with business managers, real estate agents, mortgage brokers who call us with loans that are really good opportunities, but just don't fit the traditional banks. Very stringent underwriting.
Just to touch on that, they deal a lot with just us exclusively. I have so many referral partners that if it's not a deal for them, they call me, and if it's not a deal for me, they don't call anyone else. A lot of our competition sees their opportunities from large brokerage houses that kind of shop deals everywhere, and all of our competitors are competing with each other to try and max out loan proceeds or deliver borrowers deals that no other lender will give them to try and land an opportunity. Whereas RJ and I and the rest of our sales team here have like real one-on-one relationships with people that they're not shopping these deals all over town. They're just coming to us. It gives us the access to loans that our competition isn't seeing. We're really seeing high quality deals because of these relationships.
Yeah, and interestingly enough, we saw great opportunities before interest rates climbed, right, Max?
Absolutely.
But I'd say the quality of loans that we're seeing today have actually become even better, because banks either have turned off their lending arm or have priced themselves out of the market. And so now there's a whole new borrower pool that 2 years ago could get a bank loan, but for really bogus reasons are falling through the cracks and landing in our lap, and we're taking advantage of those opportunities and getting above market returns.
Yeah, we have the ability to cherry pick all of our best opportunities for this REIT. Our fiduciary is to deliver the best loans to this REIT and to this vehicle. So that's what we're going to continue to do.
Max, you want to talk about who needs private money financing?
Yeah, so we see all types of borrowers come through our doors. It's not just, a lot of people will automatically assume and ask, well, who's going to pay 10% for a mortgage? What kind of person is that? It's really not what you think. It's not low credit, bad borrowers. We're doing a couple loans right now. One borrower we're lending to is a celebrity who's in all these TV shows. He's got 800 credit scores. He's got a business manager, millions of dollars in the bank. But his property is a piece of land he bought for $3 million a few years ago, and he needs to pay off a matured loan of $1 million. His goal is just to sell the land at this point. We see a lot of investor borrowers that look at us as a cheap partner as opposed to an expensive lender, developers, people looking to add value to real estate investments. Those type of people come to us and say, I'd rather pay 11 to 12% APR than pay a partner 50% or 25% of my equity later on. So when investors come to us, they're looking at us as a cheap partner as opposed to an expensive lender. And then we do see a lot of bridge loan borrowers too, people that can't qualify for a regular mortgage because they still have a mortgage on their current primary residence, but they need to buy a new house before they sell their old house. So we have a very creative lending product called a bridge loan, which encumbers both of their properties, helps them get into a new house before they sell their old house. They sell their old house and then refinance the balance of our loan that's left with bank financing once that old house sells. And a lot of these people are totally A-paper, bankable borrowers. We see a lot of that. So a lot of our loans are short-term. Like it says at the bottom, we offer speed, accessibility to funds to borrowers that can't get them from banks. We have expertise of all different property types, from commercial, residential, construction, land, all of that. And we're flexible, so people know we're kind of a one-stop shop for all their different lending needs.
And people, for whatever reason, when I've talked to them about private money, they seem to think that because a borrower comes to someone like Marquee Funding Group, that there's this increased risk. And I'd argue the opposite. We do holistic underwriting. We're not just looking at loan to value. We look at a borrower's ability to repay, creditworthiness, story. And I always use the example, a borrower that's coming out of college with a W-2 and good scores might be able to qualify for an FHA loan and put 5 or 10% down. Our equity requirement in a purchase money scenario is that a borrower puts 30% down, but we're still focused on debt to income, affordability, creditworthiness. And so I would say between those two examples, the borrower putting 30% down has a lot more to lose. I'd rather take that credit risk than a borrower that's only putting 5 or 10% down, but has a new job out of college.
Yeah, the keys are really the first level of underwriting is the quality of the asset that we're using as collateral for the loan. The second is skin in the game. We want a borrower that has skin in the game and something to lose if they don't perform. And number three, a good execution plan. How are they using our money, and how are they exiting the loan? Both of those, all three of those things need to pass the test if we're going to do any loan to anybody.
We've also developed great relationships, like in different markets. So if we have an asset that we really need to lean on an expert for, maybe just to understand the dynamics of a specific local market, we've developed those relationships where we can call and get the inside track on a deal. And again, that really does set us apart from some of our competition. So why Marquee Funding Group? Since 2009, we've done a tremendous amount of transactions. We've done over 3,500 loans and put to work over $3 billion worth of capital. And I think it's that transactional experience. We're not just writing huge loans. We do a lot of loans. We see all types of borrowers. And that just, I think, sets us apart from our competition just because we have so much transactional experience. And, our fund is designed to limit investor exposure through a pool of mortgage-backed securities. So in a fund, unlike being in a specific loan, you're instantly diversified amongst a group of mortgages in a pool that are high quality real estate loans that are underwritten tremendously well. So I'm going to walk you through some of the metrics as of our last quarter four 2023 report, or our last investor report. Proud to show that we were able to generate an average coupon or note rate of 9.77% while having a really good equity protection across the board. We have an average loan to value of 49.9% blended across the portfolio. So when you start looking at a balance of return and safety, I think those two numbers show really well. Generating a return of over 9.5% while having equity protection up and above 50%. I think it's definitely fits that safety bucket, that fixed income bucket that we're gonna compete with treasury bills on with, I would say, we're not the US government, but extremely safe investments, but generating better returns.
So, and just to explain loan to value, it is the loan amount divided by the value of the property. We will never do a loan that's more than 70% loan to value. What you're seeing here at 49.9% average loan to value, that means that all of the loans that we've made in our fund, the average loan amount to the average value of the total properties that we've lent on is 49.9%. So we're at a very low loan to value at less than 50% LTV. And by the way, those values are not speculative. They are hard values from professional real estate appraisers, and that's a true LTV, as we'd call it.
And since the inception of Marquee Capital Fund 1, we've distributed 2% per quarter, or at an annualized 8% return, hitting our pref quarter after quarter. So we're very happy with the performance to date. We're primarily invested in first trust deeds or senior secured loans. Just shy of 68% are in first trust deeds, the balance being seconds at around 32%. And we're invested in single family residences or multifamily between 2 and 4 units. We've really focused in on that asset class, although you will see in our portfolio loans across the real estate spectrum. But being in that 1 to 4 space has really allowed us to find good loan opportunities. A lot of the competition in the private money space is focused on commercial assets or commercial bridge loans. And so it's a heavily concentrated space with a lot of competition. And we've really found our niche in the 1 to 4 space. And it's really been fruitful for the fund, being that we have a portfolio that's under 50% blended across the portfolio, but still generating those type of returns. And Max is going to walk us through 4 case studies or closed transactions. These are all 4 loans that are in the fund that I think show the type of assets that an investor would be exposed to once invested, and they're very reminiscent of the entire portfolio. So Max, please.
These are what we look for the fund. I'm going to go a little deep on the first 2 and then kind of go quick on the second 2, but these are, like RJ said, these are the types of loans that we're looking for and consistently seeing and doing. This first one, San Diego vacation rental, this is a $600,000 first loan on a property that was worth $1.6 million. So again, just want to say that again. It's a $600,000 first on a property worth $1.6 million. We're at 37.5% loan to value, and it's a 2-year loan. Now, this loan, the purpose of it was a borrower that already owned and renovated these bungalows was pulling money out of the property to improve some other land that they owned, which they intended to sell to pay back this loan. So we gave them this cash out loan so that they can do that. This borrower makes $25,000 a month in income and has 720 mid-score credit. So strong borrower, super low loan to value, great location, about a half a mile from the beach in San Diego. Moving on to the Beverly Hills 90% completed spec home. This was a loan, $4.3 million, that was on a house at the time of the appraisal and at the time of being 90% complete was worth $14.5 million. That's not the value after completion. That was the current value at 90% complete. And that also happened to be the borrower's cost basis in the deal. The borrower has a lot of skin in the game in this case. The borrower makes minimal income, but had a tremendous net worth and liquidity. And we established an interest reserve to carry this through to the sale of the property. 36.2% loan to value first in Beverly Hills to a guy with a lot of liquidity, $25 million net worth, and a 793 middle score. So very solid, safe deal, good borrower, low LTV.
And being able to generate roughly a 10% return. Low loan to value, low leverage deal, a lot of equity protection, and a good yield, a great asset, great location. These are the type of deals we really chase and look for.
By the way, a bank won't do this type of deal because the property is mid-construction. If the property was finished, any bank would have done this in a heartbeat. Just a couple more. These are the types of deals we're doing. Palm Springs vacation rental, $200,000 senior loan, a first again, 15% loan to value, 2-year loan. It's an investment property, very straightforward. And another one, this one's actually a second. So this one is $1 million in Calabasas at 54% loan to value. You can see it delivers a higher rate than the first. Inherently, seconds, I guess, are a little more risky than the first because in a second position, you have some contingent liability having to monitor that the first ahead of you is always current. In this case, we have another very strong borrower, a beautiful house that was just renovated in the Oaks, which is the premium community in Calabasas. The house is on the market for sale, and at 54% loan to value, even if things went sideways, which this borrower has been performing like clockwork, so we don't see any problems. But in the event that it did go sideways, we have significant equity protection up and above our loan on a property that, in this case, in LA, with the market where it's at, this community has actually gone up in value because people that are living in areas that have burglaries and so on, want to go into gated communities, and there's limited amount of those products available. So this is another example of the types of loans that we're doing in the fund, and how we achieved that 49.9% LTV across the board.
And I'll also mention on that Calabasas loan that the borrower had $8 million in liquid securities, but just didn't want to sell and take on the tax liability of selling those, the stock holdings. And so it was cheaper to him to borrow as opposed to dip into his securities. And we're going to open it up to Q&A. Max, do you want to go ahead and see if there's any questions? Danielle?
Yeah, there is a tab on your screen here, Q&A, if you can see it. Just click on that and feel free to type in your question if you have any questions or want us to touch on anything again. We'll hang out and happily answer any of the questions. I might be able to actually say hello in there in case anyone needs to see where the question box is. Well, I'm going to assume no questions, but appreciate all you guys joining, and thanks for taking the time to meet with us. If you need anything, you know where to find us. Just Google Marquee Funding Group and give us a call.
Thank you for your time, everybody.